I should start first by thanking the organizers again, Ajay, Avi, my co-author on this project, and to Josh, because they have really dragged me kicking and screaming over the last couple of years to start investing in and thinking about AI. So thank you for that. And to CFAR, because I'm seeing a lot of CFAR faces here, Alan included, for supporting this for so many years. And there's a very meek, quiet guy who rarely looks up. His name is Dave Donaldson, who's taken the time to be my discussant. And just to call out to Dave is the Clark Medal winner this year, which is an incredible award in international in economics. And I'm very jealous, not because he won the award, but because it only given to people under the age of 40, and that ain't me. So clearly from this discussion, we know that there's a lot of research being done on the economics of AI, but there's not anything systematic being done on international trade, none whatsoever. And I think that that's really to our great detriment, because the fact of the matter is, as we speak, there are very significant international trade agreements being negotiated, which will have impacts for AI. Just think for a second some of the big, the big changes that we're seeing in the internationalization of AI. To my mind, China is of course the biggest one. And when we're used to thinking about companies like Google and Facebook and Amazon, and we think, these are the world market dominant players everywhere except in one place, which of course is China. And instead of Google, we have Baidu in China. Instead of Facebook, we have Tencent. We have, instead of Amazon, we have Alibaba. So, and these companies are, they're getting quite sophisticated. I think the answer is yes. So I'm going to tackle two questions. One is I'm going to try and get you to think a little bit like international trade economists who've been confronting related issues for many years. See if that fits you well, or if you think that trade economists are a bit nutty, which might be a good conclusion. And we're going to talk about comparative advantage and how you build comparative advantage, especially in the AI space. And then I want to talk about what's happening in international trade agreements right now. So what should we be worried about? What should we be thinking about? So let's start with this picture. Is that clear in the back to see that? Yep. Okay, thank you. Okay, great. I thought I had double vision. Okay, so we have, what I'm showing you is the top 10 companies in the world by market cap. And you'll see a lot of familiar names like Apple, like Google or Alphabet, Microsoft, Amazon, Facebook. So in a very, very short time, when you think that AI was just, the commercialization of AI is not very old at all, maybe 2012, these companies have become some of the largest companies in the history of humanity, right? So this is quite a remarkable achievement. What is even more remarkable is that's the top 10 companies. If I showed you the top 12 companies in the world, you will get 2 Chinese companies. So there are some very significant internationalization processes in AI, and I want to be able to talk about them. In the paper, I go through many more indicators, or Avi and I go through many more indicators of the spread of AI in academics, in conference volumes, and patenting, et cetera. So what Avi and I decided to start with is, what is the best way to characterize what AI means from this very, 30,000 feet in the sky perspective of international trade. And I think we, without quite realizing it, we ended up really focusing on supply factors, on the technology side. And we identified what we think are 4 important features. There is economies of scale in data, which I think this group understands fully well. There's economies of scale in trying to build a research capacity, trying to build a group of research scientists who can propel the company. There are economies of scope, because once you have that capacity, you can then do multiple apps, hopefully complementary apps. So apps, apps that feed one into the other. So those are 3 technology factors. And then the 4th factor is that AI is clearly a technology that is being developed, that we're learning how to build and use. So we have to think about knowledge creation and the international diffusion of AI. So with these building blocks, we set out to think about trade. And I wanted to put before you toy models, just so you'll understand how a trade economist would think about this. And you'll see immediately how we think. It's not very sophisticated. So let's just take the simplest possible model I can think of. It's called the specific factors model. There's only two sectors in this model. There are search engines, which generate ad revenue, and there's cloth, or clothing. Okay, you need AI scientists to work in only one of those two industries. AI scientists are specific to the search engine industry. And then you have workers who can move between the two industries as is needed. Now, those scientists, I don't want to have any scale or knowledge, any of my four components that characterize AI in this model. If I just start with a simple model, then it's pretty clear we're going to be in a world in which free trade is probably the best thing. There might be some minor exceptions, but probably we want to be where free trade is. The easiest way to make a case for why we need an activist policy to support, local AI developments like a Vector Institute is to introduce profits. Okay, that would be the cheapest and easiest way to do it. So let's put that in and see where it takes us. I'm not sure that we really have to. I'm going to give you this notation for 2 pages. If your eyes are tired, don't worry about the notation. The intuition is going to be pretty straightforward. So in the paper, we distinguish between scientists and firms, but let's just call a firm a scientist. And firms are different because some have better scientists and some have worse scientists. So we have the quality of scientists Q. The number of users for a firm is U for users, which is increasing in the quality of their chief scientists. They generate advertising revenue by investing in advertising, so they incur a cost, and they do an activity A for advertising, which comes at a cost. And then they generate revenues per user, which is increasing in the amount of advertising activity that they do. Okay, so now we get to what's the only thing that's really important, is the profit function. The profit function is, if you look where the advertising activity and the quality of the scientists fit into that profit function, it fits in multiplicatively, which in our gobbledygook means that this is a supermodular problem. It means that firms with better scientists will do more advertising, which means that they will generate more revenue, which means that they will generate higher profits. So now we have firms that are we have some firms that are more profitable than others. And now we enter what trade economists call the world of strategic trade policy, which was very fashionable in the 80s and 90s, in which you want to try and repatriate to your country activities that generate lots of profits and rents, the good jobs, the high profit firms. Okay. Now this was very popular in the 80s and 90s, but it's not popular anymore. And there's many reasons it's not popular. I'll give you just one. We think that there's free entry in many of our markets. Free entry tends to dissipate ex ante profits. So if there's no profits ex ante to play with, to bring home to your country, then there's really no case for strategic trade policy. So that's one example of why trade economists have been very loath to start thinking about why the government should be spending money on corporations in order to attract them to a jurisdiction. But let's now try something a little different. I haven't used any of the 4 characteristics of AI, so let's put in one of those 4. It really doesn't matter which we put in. I'm going to put in that there's scale. Okay? And the reason for choosing that is just an obvious fact that if you look at the distribution of firm sizes in the market for search engines, or here measured by how many searches, the share of the world's searches being conducted, you see that Google has about half of all the world's searches, and the next 3 major players each have about 12%. So it's very skewed. So it makes you think that if you have the best scientists in the market, not only do you get a proportionally higher share of the market, you get a disproportionately higher share of the market. So we're getting scale. It's not a regular superstars model, which is usually talks about demand side. This is on the supply side that we're getting a superstars effect. So if we just assume that the number of users is convex in the quality of the chief scientist, then we get that everything is convex, meaning revenues, firm size, payments to scientists. In short, we start getting a few firms that are earning spectacular profits, and it becomes more compelling to start arguing, boy, if our country only had those few firms, that would be worth something to us. We'd be willing to spend taxpayer money to attract those firms. So now we get a stronger case for strategic trade policy. And just one single caveat to that I think is important and will be discussed in these sessions tomorrow, is that these are policies that are subsidizing big, rich corporations and individuals who are already earning a very good living. So just a caveat that I'm not going to discuss here, but it's hard to ignore that fact. All right, 5 minutes left. Okay. So let me skip ahead. Oh, okay. Let me say one more thing. Forget about the math there. When we start adding in that make scale enter in a more compelling way, or we start to add in knowledge spillovers, what comes out of a very large class of international trade models and of endogenous growth models is that it's very important to know where the externality is that justifies a government intervention. And in trade models, which is what turns out to always be crucial, and in endogenous growth models is, am I building on a scale effect which is very local or which is international? Am I building on knowledge, which when I develop new technologies, I'm building on existing knowledge which is very local or international? Because if it's international, my government spending money to subsidize the industry, all of that money is going to leak out to other countries. For example, for the Vector Institute, I'm sure you've thought hard about this. What happens if the students that we train here leak out to China? And I'm sure you must, you're probably thinking about what policies have countries like Singapore used to try and retain the people that they train. All right, let me go then to current trade negotiation issues. I think that's an area that probably most of you have not thought very much about. And they're very difficult to understand. It is true. And for most of us, we understand tariffs, but we don't understand the many behind the border pieces of legislation that are in trade agreements. So let me just give you one example, I think, that really helps me think about it. It's my cell phone. And my cell phone, as you know, and I'm going to choose privacy because this way it makes, I think, you teed me up for it, so I chose privacy. This cell phone sleeps with another cell phone almost every night, right? And data aggregators probably know the cell phone numbers and know that that person is my wife, and they know all about me. But the cell phone aggregator might notice that occasionally that cell phone sleeps with somebody else. Not very, and they might draw a conclusion from that maybe Dan Trefler is not very monogamous. And we know that people who are not very monogamous are high credit risks. So suddenly, just where my phone is sleeping and whose phone is sleeping next to becomes credit scoring for me. Okay, so it highlights, I think, to me, two things that are important. One is the issues that you've already raised, Catherine, which is there are legitimate demands for privacy. The other is that these data do allow for very interesting economic activity that could improve welfare in some dimensions. So we have this battle between privacy and data as a driver of AI. So that leads me to three observations. The first is that weak privacy laws are a source of comparative advantage to jurisdictions. And that's a hard thing to swallow. It's a very hard thing. It sounds like environmental regulation. Race to the bottom is good. And that's really worrisome to me, but it's a fact of life. So we're going to have to make choices. It's not for economists or for data scientists to make those choices. Politicians are going to have to make these choices for us. The other is policy and flexibility. That there's a fundamental difference between a domestic law and an international treaty, because a domestic law can be altered and changed and can mature as technologies mature. International treaties cannot. So when we lock something into an international treaty, we're not going to revisit the issue for at least 20 years. Okay, so where are we with trade negotiations? I'll give you just two of them that I think are have received a lot of attention. The first is TPP. TPP was, despite all the attention it received, was largely aspirational. That's trade jargon for countries were asked to say, our goal is at some unspecified date to look a lot like the United States in our regulatory approach, but no commitment. NAFTA 2.0. Let me just summarize then what I think are the main takeaways from this, which is as we all know, there's this internationalization of AI, which is proceeding apace. It's fundamental in thinking about what policies work. We need to think about these attributes of scale and knowledge creation and knowledge diffusion. We should not be thinking about policies without thinking about those elements. And then we have to remember that behind the border policies can lead to innovation and consumer gains, if done right. They can become a source of comparative advantage for a jurisdiction, but they also lead to an incumbency bias potentially, because the companies that are pushing hardest on the trade front are the companies that are looking to advantage themselves, and those are very large corporations. It leads to a race to the bottom, and it leads to regulatory flexibility. Thank you.
Okay, Dave.
So thank you very much for the chance to be here. This is not an area of my expertise, but it was a ton of fun to learn more about, both here and in reading the paper. The paper is kind of just a wonderful, wide-ranging, creative, fun to read discussion of almost all of the issues I could think of. So I have very little to add. The quick summary at a very high level is, which is a lot about how, very similar to how, if you're a labor economist thinking about these issues, or if you're an IO economist thinking about these issues, or if you're a trade economist thinking about these issues, you start thinking about it. It's a technology, and we think we know a lot by now about how the implications of a change in technology for the economy in the domain we're interested in as a function of the features of that technology, right? And so, in some sense, it all comes down to what those features look like. So, obviously the implications for factor prices for inequality will depend on the nature of the technological change in terms of its goods bias and factor augmenting biases. In fact, Dan's early work kind of wrote the book on some of that, just how easy it is to fit very complicated forms of technological change into standard Heckscherlian models of inequality. That was his 93 paper. And then goods bias technological change into a Heckscherlian model, that was his 95 paper. There's complications, obviously, with mobile factors that again, we're kind of used to thinking about if we think the factors are mobile. There's implications for trade policy that go beyond the usual kind of protectionism as a form of kind of rent distribution, or protectionism as manipulating trade prices, but actually protectionism as potentially, or subsidies as potentially correcting domestic market failures that you can't correct for some other reason with conventional industrial policies. If we know, again, something about the features of the technology in terms of things like how geographically local are some positive externalities like knowledge spillovers or external economies of scale. So for me, the big question, I think this has been echoed many times today, is kind of exactly what are the exact features that we expect this technological change to look like? And of course, that's a bit more speculative. So there's not a lot that these authors could be kind of asked to say about that. So what I'm going to do is sort of just add a couple kind of additional features to this discussion that didn't come up in the paper that I think are worth thinking about, and also talk a little bit about what we know about some evidence about some other big innovative activities and what the technological features of some technological features of those innovative activities look like. Okay, so just in terms of what matters, obviously, is fleshing out a bit more of those details. Is obviously the nature of economies of scale, be they in the innovative process or in the production process or some combination. We talked about the economies of scale from data or potentially not. That's an area of debate today. I've seen the external to the firm versus not. That's another. We've heard the word commodification of these services, commodification of data versus not. That's again an active debate. That obviously a lot of policy implications will hinge on. Same thing for knowledge spillovers. Paul Krugman 30 years ago said he didn't find this particularly intellectually interesting to think about because there was no discipline on the question of how far will the spillovers spill. Nowadays we have data, we have empirical estimates that we can bring to bear on that to sort of exactly just feed in that. It may not be super interesting from a theoretical perspective to write down a model where there is some spillover, but it's super important from a policy perspective to know how far they go if they do. An interesting anecdote in the paper I wasn't familiar with was sort of why some of Google's machine learning operations, I gather, are in London and in Edmonton. And the story in the paper was that those are because of the sort of the preferences of the lead scientist in terms of where he or she was wanting to live at the time. And I guess that tells us, that there's sort of evidently huge knowledge, huge geographical reach of knowledge spillovers, at least within the firm, right? The company is willing to sort of put the location almost anywhere relative to its headquarters locations. And then finally, there's, even if we knew about this stuff, and I'm going to sort of, as we know, that's where a lot of the open questions are, there's the usual problem of picking winners, which the paper talks about. A couple fun recent papers I'd seen on this, very, very far removed in some sense, but David McKenzie and co-authors have written a recent AER paper, a very nice paper, where they sort of in Lagos, in Nigeria, gave out a sort of, among a series, a large number of applicants, entrepreneurs, with a business plan, a sort of viable business plan. They were submitting to a business plan competition. Some of them were then sort of chosen randomly to be put in a pot where they would be randomly allocated whether they won that business plan competition funding, sort of startup funding or not. And they were able to follow the impact of that funding on those entrepreneurs and saw that it was a real impact. There's a sort of follow-up paper that says, well, obviously randomly giving out funding is a pretty bad distribution mechanism. Let's see if we can do better. So they sort of compared two mechanisms, again, randomly. One was a machine learning algorithm that, based on the pre-attributes of those entrepreneurs, tried to predict and the business plans, tried to predict which ones were worth funding. And another was a panel of local experts who usually hand out the funding and asked them too. And neither of those approaches was capable of actually, in any meaningful way, successfully predicting which business plans were worth funding. So again, it just highlights, in a scientific way, just how hard the picking winners problem is, at least in that domain. Okay, so then the next thing that came up in the paper was that if either of these positive externalities are there and are not geographically global, then we should expect that there's sort of, that is, there's some element of local external, as something like local external economies of scale happening. When I say local, I just mean within some geographic domain, like a country or a city. So that turns out to imply that you should see something that trade economists since Krugman and Linder have called the home market effect, which is basically this idea that suppose you just happen to have, for some reason, a large home demand for your thing in your industry, would you then be more successful than otherwise at actually exporting that thing? In standard models, a large home demand is actually a curse for an industry because it sort of pushes them up their supply curves and makes them less efficient, less successful in export markets. But in non-standard models, like ones with external economies of scale of some sort, like the sort that Krugman made famous, then you get the opposite. Home demand is a great thing. It makes you bigger, it makes you more efficient, it makes you more successful at selling to foreigners. And so in some recent work that I've been doing with co-authors, we've been wondering about sort of how strong that looks in a particular sector, which is the global pharmaceutical sector, and it's incredibly strong. So there's sort of a revenue, an as if external economies of scale revenue elasticity. That is to say that if you doubled your home revenues, you would sort of be 80% more effective at selling to any given kind of third foreign destination market. We use a sort of demographically driven source of demand, home demand variation in this pharma sector that we think is unlikely to be correlated with supply side stuff. It's a huge elasticity that is actually, it's huge, but it's actually small it's a little bit smaller than the one typically assumed in normal trading growth models with the Dixit-Stiglitz formulation for monopolist competition. So it's kind of there, but again, maybe not quite as big as you might have expected if you didn't look at the data at all. And in some other recent work with others, we've been trying to extend that to all manufacturing industries, and we get something in the same ballpark, if maybe a little bit weaker. So in these kinds of sectors, there's evidently something very real, which is that home scale matters a lot for sort of your efficiency and hence your ability to sell to others. Okay, so the final thing I would just talk about is that unfortunately this isn't just purely about domestic technology. There's also the issue of trade costs. Trade costs evidently matter. The world is not flat, as NBER pointed out in his review of Thomas Friedman's famous book. Trade declines massively with distance. That's true today in France, for example. It declines massively in distance, except for to Francophone and former French colony countries. And so that implies that these kind of frictions of trade are probably a very big deal. And so anything that AI might do to reduce those would also be a very big deal. And there's a whole list of possible reasons that might very much happen. This doesn't get discussed in the paper, but I think it's worth discussing. Recent work has characterized that sort of firms evidently do know a lot about their relevant market features. in their very complicated exporting problem of what to sell where, at least half of kind of what they would know in a perfect world. I think that's a lot. But evidently the frictions must be massive. So it's not so much an information problem, but some kind of actual technological problem. Okay, and so the final thing I would just say is that I think that there's also the scope for an interesting thing they could add to the paper that would be interesting to think about, which is interactions between that domestic technology and the trade cost technology. I think here, the most exciting thing that's happened to trade costs in the last 20 years is just the ability for certain services to be tradable nowadays, in terms of exciting the implications for the world. I think the same, it's very implausible that many of those exact same activities that in the last 10, 15 years have been easy to sort of buy from India, like maybe radiology services, are suddenly going to be very easy to buy from the cloud instead. And so that tradability kind of in certain tasks that suddenly dramatically changed, is those exact same sectors are about to sort of be maybe perhaps the exact sectors that are most disrupted. And so that interaction between trade and technology is again, I think, interesting.
Thank you. Question?
Okay, end of day. Okay, so, wait. Rebecca.
I'm sorry, that's such an interesting paper. So would you feel comfortable telling us what you really think? About if you were, say, the US government, would you be massively subsidizing AI investments? Would you be changing policies, or is it not a big deal?
My gosh, that's a big question, but I would start by saying that we don't do policies in isolation, right? And these are policies that have to go hand in hand with building a social welfare net in the U.S. So I've always emphasized K through 12 and higher is we need to address the fact that the school quality in various parts of the U.S. is horrible. Before we start, that's part of where our tax dollars have to go to. Then, yes, I think that the R&D blitz that the U.S. and under programs like DARPA was so effective at for so many years, I don't understand why they've let that sort of go by the wayside. That seems to me a very big mistake. And then I think initiatives like the Vector Institute, like rethinking advanced education, those are all going to be important parts. But I do want to emphasize that at the end of the day, if it's not inclusive and it's not broad-based, it's not good enough that the Bay Area becomes spectacularly rich. That is not what I would describe as an effective policy. So there has to be some way of making sure that everybody is tapping in to this. So it's not just binary. Should we be subsidizing this sector? It's how does it fit with other policies that we need to shore up.
Great. Catherine.
Yes, so I just wanted to pick up on this idea of the privacy race to the bottom. So my experience has been, when I've been in Europe, surrounded by privacy policymakers, they're always inordinately proud of their ability to influence US privacy policies through trade negotiations. So for example, they've managed to replace the safe harbor policy with something they call Privacy Shield, which we might think of as imposing costs on US tech firms. And so I was just wondering if there's a model to sort of explain that import or ability to impose costs on other countries through the language of AI, data, and privacy.
Okay, I guess I'll take that. What do I want to say? So we haven't thought about that explicitly, except for to the extent that we still don't see successful European AI companies. So these policies have been successful at penalizing American companies without creating a set of European companies. So it seems it is it's depending on how the costs are allocated, it could just be a deadweight loss that the Europeans have decided to impose on the Americans. Or it could be a transfer, depending on the specifics of the policies, from American companies to European government. But to the extent that it's hard to see how that's facilitated domestic industry, at least. Okay, I think we're getting tired. So maybe if there's no more, oh, one more, great.
Just one small point, building on Dave's home market effect. I mean, it seems like a cluster is one natural micro foundation for that. And if we think that clusters are strengthening with time, which I think we do, as increasing concentration and innovation, then it seems like that initial subsidy, regardless of whether it's sort of convex at the firm level, kind of a real stickiness to it in terms of long-term success, just because of those kinds of Marshallian kinds of local spillovers and interactions. So there may be a short-run strategic investment trade policy might lock you in a long-run sense.
You know, I'm sure you might know this literature even better than I, but when you take a look at, you know, sort of meta-studies of clusters like Porter's work, it's really surprising that the things that we think matter because we hold in our heads, you know, Silicon Valley, really don't matter that much writ large when you look at hundreds and hundreds of potential clusters. In fact, the thing that often matters the most is something that we wouldn't think of as having any externality directly, and that is great universities. Right? Great universities, and I know that's very self-serving, but that's what the data are showing. So, you know, investing in education often has these big spillovers. The other things that might be externalities locally tend to be, Will Strange could speak to this much better than I, they tend to be really related to personnel, to labor market pooling and so on. I mean, that's the data that I've seen. I haven't done a comprehensive assessment of cluster literature in a long time, but are there other things that you think are really core to, you know, to points of contact with policy that I've skipped over?